We looked at the types of share capital, types of share capital. We also looked at the prospectus. We also looked at statements in lieu of a prospectus, a statement in lieu of a prospectus. We also discussed something briefly about a misleading prospectus. A misleading prospectus. So we need to also know something about methods of issuing shares. Then there's something about maintaining the share capital, share capital, and the rule in Trevor versus Whitworth. The rule in Trevor versus Whitworth. The rule in Trevor versus Whitworth. Then there's something about reduction of the share capital, Then the last thing to know here is something about dividends. What is actually dividends? And there's something about dividends mandates and vouchers. So all this is what you need to be able to know under this particular topic of share capital. And I think we had discussed up to this particular level where we were talking about a misleading prospectus. So we simply said that share capital is a means through which a company can be able to raise its capital, or how it can be able to finance its business activities. One of the ways is through a sale of shares. If the company is able to sell shares, then it will be able to raise what we call share capital. So that money contributed in terms of after selling the shares is what we call share capital. So we looked at the different types of share capital. We discussed them. So we said we can have authorized share capital. Sometimes it is known as the nominal share capital. Or sometimes it can be known as the registered share capital of the company. So I think that one we noted down. So I don't need, I need to write it here again. So we looked at issued share capital, unissued share capital, reserve share capital. We looked at called up share capital and called up share capital, some of the types of share capital you can actually be able to have. And then we looked at the prospectus. So we tried to discuss what is actually a prospectus. We simply say that prospectus, it is simply a notice, or we can say an advertisement that is normally given out or issued out by a company, inviting the members of the public to be able to buy into either, it can be the shares of the company or maybe the debentures of the company. So at this particular point, when I mention shares, so I think you'll know very quickly what are actually shares. But of course, debentures, we look at them deeply, what we'll be able to understand what is a debenture when we'll be looking at the topic of debt capital, which is actually just the next topic after this one. So it is simply a notice or an advertisement that is normally given out by a company. That notice, we said it can be in a newspaper, it can be over radio announcements that the company is selling its shares. So they'll give out what we call a prospectus. So that is what we mean by a prospectus. We looked at the contents. So part of the contents of our prospectus, we said, basically, it will be talking more about the company itself, and of course, that particular prospectus in terms of the shares that are being given out by the company. So most obviously, from the prospectus, you'll most obviously tell the name of the company that is giving out the shares. There's someone making noise here. Is it George? George. You can mute yourself, I think. So if your background has some noise, you can just mute yourself, because if there's some noise in your background, it affects the others. It affects the others. They cannot actually be able to get the teacher very clearly. So just mute your background unless maybe you have a question. Is when you unmute. You just unmute and ask the question. But if there's no question, you just mute your background. Then of course just listen to the teacher. So we are saying parts of the contents of the prospectus will be, you'll be able to tell the name of the company that is giving out the shares. You'll tell the classes of shares that are being issued out by the company. You'll be able to tell whether these shares are being issued at a premium. So we can be able to tell whether the shares are actually also being issued at a premium, and actually explained what is actually a premium. So we say this is basically the amount over and above the par value or the face value of the shares, over and above the par value or the face value of the shares. So if each share is actually supposed to go at 10 shillings and the company issues at 12 shillings, the 2 shillings is actually the premium. And we said it is normally maintained in a share premium account. So you'll be able to tell also the directors of the company and what are the qualification shares they actually hold in the company. You'll also be able to tell from this particular prospectus other attachments that will be there. We said there'll be a report about the balance sheets and income statements. We said for the last 5 years, you'll be able to tell. Then also you'll get a dividends report of the company from the prospectus for the last 5 years also. And we said also if the company is to venture into a major project, then it simply means that there'll be a report by a special accountant clearly indicating what are the main reasons as to why the company actually intends to raise the share capital, So apart from just the other contents, these particular key reports are actually very important to be attached on the prospectus so that it can be able to tell the investor or guide the investor whether this is actually a very prospective company to invest in or not. So you said you can be able to tell it from these particular reports, because if you look at the income statement and the company is actually very profitable, so there has been a growth in terms of profits for the last 5 years. So most probably you can decide to invest in the company because at the end of the day, you'll be able to get good dividends from the company. So if the company has paid dividends consistently for the last 5 years, it can be a clear indicator or to you that this is actually maybe a very good company to be able to invest in. So we looked at that special report by the accountant. You said, for example, if the company is to venture into oil, there must be a special report by the accountant clearly indicating how the company intends to use the investors' money to venture into oil mining. So oil is actually a very valuable product. So most probably if the company has discovered oil and they're looking for capital to be able to mine the oil, it will be a very valuable company in the near future, maybe in the next 2 or 3 years. Once they start selling that particular oil product, it simply means that the company will become very valuable. And of course, if you bought shares at maybe 10 shillings, maybe after 2 years, the value of the shares will actually maybe be at 20 shillings. So these reports are actually very important to be attached on the prospectus so they can be able to guide the investor as to whether he can be able to buy the shares or not. So you can tell from that particular prospectus or notice given out by the company. So we said sometimes the company might decide not to go out publicly, but of course to do it privately. So they basically target private investors in the economy. So they know these people actually like investing. They are good at actually investing. So they approach them privately and they give them what we call a statement in lieu of a prospectus, simply a representation of a prospectus. But now in this case, it is actually done privately and it is not actually done maybe in a public way by maybe giving out notices in newspapers, but they just focus on those particular key investors and they approach them. So the keyword there is private, in a private way, privately, and give them as statements. It's just like a prospectus, but now in this case, it is now being given out privately to basically an investor or a prospective investor who is likely to invest in the company. And they convince this particular investor to buy the shares of the company instead of the company having to go out publicly by issuing out the normal prospectus. So he said if the prospectus contains what we call misrepresentation of facts, or basically information which is not actually factual or not true about the company, Such a prospectus, we said it is actually known as a misleading prospectus. So it's basically not giving out true information. For example, in this case, if they have clearly indicated in that particular report attached that the company has consistently made profits, yet it is not actually true, it simply means that that particular prospectus will actually be a misleading prospectus. So when we talk about a misleading prospectus, it is a prospectus which contains information which is not factual about the company, or contains what we call misrepresentation of facts. So those information which are not actually true about the company and they are contained there, the prospectus will be seen in wholesome as actually being a misleading prospectus. So say this one is not actually allowed under the law. And of course, if you as an investor, you ended up buying shares in a company due to a misleading prospectus, you have certain remedies. So the first remedies you can have remedies against the company. So remedies against the company. And of course, number two, remedies against promoters. We can have directors, or we can have experts. So also experts can be held liable. So these particular parties are liable because they are the ones who will sign, because part of the contents of a prospectus, it must be signed by the directors, because they are the ones who normally get involved in the preparation of the prospectus. So at the end of it all, before it is actually given out or issued out to the public, it must be signed by those who actually prepared it. So the directors are the ones who normally get involved in the preparation of the prospectus. So they'll sign the prospectus. Also promoters. So if you can remember very well, when we are talking about formation of a company, we say that, for example, in this case, if the promoter is forming what we call a public company, he'll be involved in the preparation of the prospectus to invite people to buy the shares of that particular public company on formation. And of course, you said he can be given commission as a way of remuneration for having basically been involved in the preparation of the prospectus, which basically invited people to buy the shares of the company on formation. So promoters also, if they sign the prospectus, maybe on formation of the company, they can be held liable if the prospectus is actually containing information which is not actually true about the company. Experts, these ones are actually basically liable because we've said here, part of the reports that are normally attached on the prospectus is, for example, a special report by an expert or a special accountant. So that special accountant is actually an expert who can be held responsible, because if he attaches or clearly provides a report to the company that is basically included in the prospectus, which is not true about the company, it simply means that that particular expert will be held personally liable or will be held responsible. And then also the company as a whole. So there are certain also remedies the investor can be able to take against the company itself as a whole. So before we look at deeply into the remedies, so maybe there's a question I want us to look at. So there's a particular question that was tested in a particular setting. Let me see if I'll be able to get it. So the question is here, it was tested in November 2016. It was tested in November 2016. It's question 1C. Question 1C. It's question 1C. Question 1C. Question 1C. So we can have someone read for us. We can have Lucy. Lucy, you can read for us the question. Or you can read the whole of question 1. The whole of question 1. Lucy. Yes, Lucy, you can proceed.
A company cannot own its own executes contracts. Describe 3 mechanisms provided by the Companies Act by which the company can sign documents. Greenpark Limited issued a prospectus inviting members to a public to subscribe for its shares. It was stated in the prospectus that the money was required for the purchase of a modern equipment to be used for expansion of the company's business. On the strength of this statement, Rose Sagina purchased shares of the company, but she since learned that all the money received was used to pay the debts of the company, which were long overdue. Rose Sagina feels shortchanged and seeks your legal advice. Analyze the legal principles applicable in the above case and advise Rose Sagina appropriately.
So you can be able to see that that particular question is actually basically touching on a misleading prospectus, that this particular lady known as Rose Sagina relied on that particular prospectus of the company to be able to buy the shares of the company. So in the prospectus, they clearly indicated these particular amounts that are being raised out of the sale of the shares are going to be invested in the purchase of a modern equipment. But instead, the company went ahead and actually basically used the money for another purpose. So in this case, you can be able to see that Rose Sagina was actually shortchanged as a result of that particular misleading prospectus, So maybe we can just write the answer, then I'll explain deeply more about a misleading prospectus. You can just write the answer and say, the legal principles applicable relate to a misleading prospectus. The legal principles applicable relate to a misleading prospectus. Relates to a misleading prospectus. First of then you just say a misleading prospectus is a prospectus. A misleading prospectus is one, or just say is one, which contains, a misleading prospectus is one which contains, a misleading prospectus is one which contains misrepresentation of facts, misrepresentation of facts, which contains misrepresentation of facts, which contains misrepresentation of facts about the company, which contains misrepresentation of facts about the company, misrepresentation of facts about the company, or the intention, stroke purpose stock purpose for the issue of shares, stock purpose for the issue of shares, stock purpose for the issue of shares of the company, stock purpose for the issue, intention stock purpose, intention stock purpose, stock purpose for the issue of shares of a company, for the issue of shares of a company, for the issue of shares of a company, full stop, full stop. Then you just say, in this case, the money raised, the money raised by the company out of the issue of shares. In this case, the money raised by the company, out of the issue of shares, was not used for the intended purpose, and therefore Ross Sagina will have the following remedies, and therefore Ross Sagina will have the following remedies, and therefore Ross Sagina will have the following remedies, and therefore Ross Sagina will have the following remedies, will have the following remedies, semicolon, will have the following remedies, therefore Ross Sagina will have the following remedies, and therefore Ross Sagina will have the following remedies. Then you put a semicolon, then you say number 1, remedies against the company, remedies against the company, then you say number 1, A, resigned or cancel the contract, of allotment of shares, resigned or cancel the contract of allotment of shares, resigned or cancel the contract of allotment of shares. Number B, sue for any damages, incurred, out of the purchase of the shares, So sue for any damages incurred out of the purchase of the shares. Sue for any damages incurred out of the purchase of the shares. Sue for any damages incurred out of the purchase of the shares. Number C, sue for negligence. If there is proof, there was failure of duty of care by an officer of the company. Sue for negligence if there is proof there was a failure of duty of care by an officer of the company, So we've said number 1, resigned or cancel the contract of allotments of shares. Number B, sue for any damages incurred out of the purchase of the shares. Number C, sue for negligence. So negligence is a tort that you can actually be able to bring before a court of law. So long as you can be able to prove there was a duty of care by an officer of the company and he failed to observe the duty of care. So you're saying sue for negligence if there's proof there was failure of duty of care by an officer of the company, by an officer of the company, by an officer of the company, by an officer of the company. Then number two, so this was part one. These are remedies you can be able to take against the company. So part number two, what you can be able to do. So number two, sue for compensation, sue for compensation, compensation of any loss against the directors, stroke promoters, stroke experts of the company, experts of the company. You can sue for compensation for any loss incurred out of the purchase of the shares because they are the ones who approve the prospectus. So these persons we are talking about, directors, promoters, experts of the company. So these are some of the remedies that this particular lady known as Ross Sagina can actually be able to take out after discovering that he had actually been given what we call a misleading prospectus. So in general, but basically what you should actually be able to gather out of this, that it is not actually okay for a company to give out what we call a misleading prospectus. So any investor who has actually been duped by a misleading prospectus to buy the shares of the company, he'll have these particular remedies. What you can do, you can simply just cancel that contract of allotment and ask the company to give you back your money instead of having to be an investor in that particular company or a shareholder. Number two, you can simply be able to sue for any damages. What we mean by damages is that there's a lot you actually incurred in terms of, for example, expense, for example, time you invested in basically buying the shares. You ended up basically making queuing for a very long time. You spent either money or in terms of transport from maybe Mombasa to Nairobi to basically apply for the shares. So those are damages you incurred. Those are losses you incurred. So you should be compensated. So you can actually be able to sue the company and ask them to pay you for all those amounts instead of just only paying for the amount of the shares. Also, basically anything that you incurred in terms of costs, you basically got the application forms, you spent a lot of money, so they have to compensate you for all that. Then in case you can be able to prove there was some form of negligence, you can also actually basically sue that as a form of tort before a court of law. And under negligence, basically what we normally say, you have to basically ensure that there are three key elements present. So one, basically there is what we call a duty of care. Then of course, that particular officer of the company failed on his duty of care. As a result of that, you ended up making losses out of the purchase of the shares. So you can simply go to the court and just bring a case known as negligence. So long as you can prove those three. There was a duty of care by an officer of the company. This officer of the company failed on his duty of care. As a result of the failure of the duty of care of the officer of the company, you ended up making losses. So maybe he was supposed to advise you because it is expected is like, for example, the company secretary to advise you while you are buying the shares. So he didn't actually do that properly. So basically you ended up buying the shares. So since he failed on his duty of care to advise you as an investor, you ended up buying the shares and ended up making a loss. So you can sue for negligence because that is an official person in the company. The company has appointed that particular person to advise investors. So the company will be held liable in what we call in a vicarious way or vicariously liable as a result of the work done by the office of the company. So then also you can go for, instead of having to go for the company itself, you go for the persons who basically signed the prospectus, the directors, because they're the ones who normally get involved in the preparation of the prospectus, or maybe promoters on the formation of the company, or maybe you can go for the experts. Experts have already told you how they get involved. because there are certain reports that might be attached on the prospectus. They're the ones who will be involved in that particular preparation of the reports. For example, auditors of the company. So they prepare financial statements, which are basically relied upon by people outside the company. So if they don't give out true information, they can be held responsible for what was actually contained in the prospectus, So these are basically the remedies that can actually be put forward by that particular lady known as Rose Sagina. So maybe before we proceed to those other two questions, so we've said here that one of the, under these particular remedies, that one of the remedies here is that you can rescind or cancel out the contract of allotment of shares. But here, there's something you need to be able to note here, that this cancellation or rescinding of contract of allotment, we normally say it must be done within a reasonable time. So there are certain aspects or that must actually be present before you can actually be able to go ahead and actually cancel the contract of allotment. For example, number one, we normally say that you must have not affirmed the contract of allotment. How will we conclude you have affirmed it? For example, if they have allotted the shares and you've actually ended up enjoying dividends in the company, you've already affirmed the allotment of the shares. Ni kama umekubali already kwa sababu umeanza kuenjoy dividends. Umeattend meetings, general meetings, AGM umeattend. It's like you've already affirmed that I'm already a member of the company, I'm a shareholder of the company. In such a case, you lose the right to rescind or cancel the contract of allotment. Because it's like you've already, this basically allotment, they allot the shares. Now, basically, once you accept them, you've entered into a contract with the company. So it's like now the deal has been sealed. So it will actually be affirmed. For example, if you end up basically enjoying some of the membership rights, getting dividends in the company, in such a case, if you do such, you lose the right to rescind or cancel the contract of allotment. Maybe you can use these other means to basically sue the company for basically compensation for a misleading prospectus. But if you have actually basically, for example, already affirmed the contract of allotment, in such a case, you lose the right to rescind the contract. You've said, number one, what actually normally happens, you lose the right of rescinding or cancellation of contract of allotment if you have affirmed that particular contract. How do you affirm it? For example, if you enjoy dividends in the company, you attend meetings in the company, you would have already affirmed the contract of allotment. So you lose the right to cancel that particular contract of allotment. Number two, if the company has already started undergoing what we call liquidation, you lose the right to rescind or cancel the contract of allotment. So in such a case, the company is like now it is going to shut down or basically is going to be liquidated. In such a case, you can't rescind or cancel that particular contract of allotment because maybe in a few months' time, the life of the company won't be there. So if liquidation process has already started, you cannot cancel or basically deny that you are not the member of the company, or basically you cannot say that you are actually misled to buy the shares of the company during that particular moment where now the company has started to be liquidated. So you are saying, number two, in case the company has already commenced liquidation, you lose the right to rescind or cancel the contract of allotment. Number three, where we normally say where restitution integrum is not possible. So that is actually basically in Latin, whereby they cannot actually return you to the original position. So we say restitution integrum is not actually possible. So in this case, we mean that, for example, if you bought the shares, you as, for example, D, if D bought the shares, and of course D transferred the shares to Purity, it simply means that D is no longer a member of the company. So she cannot come later on and claim that those shares I had bought initially before I transferred them, I bought them as a result of a misleading prospectus. Therefore, I want to cancel the contract of allotment then, because you've already lost membership to Purity. So it simply means that in this case, D cannot actually be able to come and basically cancel the contract of allotment. So we say where restitution integrum is not possible or is actually impossible, it simply means that you cannot be returned to the original position. How does it happen? For example, if you've already transferred your shares to another party, You cannot come later on after you've already transferred the shares and claim that you want to cancel the contract of allotment, because you cannot be returned to the original position. So that is number 3. Number 4, where you are a person of such an experience or knowledge. Purity wants to get where restitution intergram, I think it's like this, intergram is actually not possible. Where restitution intergram is not possible. So I think it's like this. But of course, if you check your notes, it's actually there. So you can be able to also just see it. If you check your notes, you'll see it. So you're saying number 4, where you are a person of such an experience or knowledge, it is not actually possible to be duped by that particular prospectus. Maybe you are an expert who understands things to do with shares. You are maybe an expert dealing with the company. So you cannot actually be misled by the prospectus, but you ended up being misled by the prospectus. In such a case, you cannot rescind or cancel the contract of allotment. So those are some of the reasons whereby you will lose the right to rescind. You know, the question can come in the exam. Under what circumstances can an investor lose the right to cancel the contract of allotment? What has the teacher said? The teacher has said that, for example, number 1, if the company has already commenced liquidation. Number 2, where you cannot be returned into the original position. Number 3, where you are a person of such an experience or knowledge such that you could not have actually been misled by this particular prospectus, So under those particular circumstances, then you cannot actually basically be able to rescind or cancel the contract of allotment. And then also you must do it within what we call a reasonable time. You don't have to wait for a very long period of time. So you don't have to wait for a very long period of time so that you can rescind or cancel the contract of allotment. So you simply need to do it within a reasonable time. That is basically what you need to be able to understand about a misleading prospectus. And most probably, that's where basically they can actually be able to test a question with regard to a misleading prospectus. So we can look at the other 2 questions before now we proceed to methods of issuing shares in a company. So I think these are the questions we're talking about. Like the first one there, it is coming from classification of companies. It is saying, with reference to classification of companies, explain the meaning of a holding company. Explain the meaning of a holding company. Explain the meaning of a holding company. Explain the meaning of a company in relation to another company. So a holding company, I think those who have done financial reporting, I think all of you are doing financial reporting. So you've come across what is a holding company. So under the topic known as consolidation, you'll be told that there are things like these are holding company, then there's a subsidiary. When it acquires 50%, there's a subsidiary, and there's another one like an associate. So things like those ones. So what we mean by a holding company, so you can simply just be able to say a holding company is a company that has acquired, a holding company is a company that has acquired ownership, in another company, is a company that has acquired ownership in another company, and therefore able to control, the activities, or affairs, of the other company, and therefore able to control the activities or affairs of the other company, and therefore able to control the activities or affairs of the other company, or affairs of the other company, Full stop. Then you can just say the other company is a subsidiary. The other company is a subsidiary. The other company is a subsidiary. The other company is a subsidiary, or is known as a subsidiary company. The other company is known as a subsidiary company. The other company is known as a subsidiary company. That other company it has acquired a stake in or ownership, it is known as a subsidiary. So a company can acquire ownership in another company. So since we say that company is a person, so just like you, the same way you can acquire shares in a company can also acquire shares in another company. It can own properties. That is one of the characteristics of a company. It can acquire ownership in another company because it is viewed as being a person under the law. So that's what we mean by a holding company. So therefore, it is normally actually, you'll be told in financial reporting, it is 50% plus up to around 100% there. So that is basically when now the other company will be known as a subsidiary. Therefore, it will be able to control the activities of the other company in this sense because it will have the majority of the voting rights of the company because it is 50% plus, so that is majority. It can be able to control the activities. So before basically that other company undertakes any activity, so this holding company must be consulted because it controls the major voting rights of the other company. Therefore, it is able to control the activities of the other company, So there are several companies like we can be able to quote, for example, Centum. So if you've heard about a company known as Centum, you can check, they have ownership in several companies. So like Two Rivers, so Two Rivers as a company, so Centum has a stake in Two Rivers and other Trans-Century. So they have several ownership in other companies like this bank, they have ownership in, I've forgotten the name. There's a bank they actually also own, so Centum as a group. So they have ownership in that particular bank. So Centum now will be known as a holding company, while the bank and Two Rivers will become the subsidiaries. So part B, a company cannot on its own execute contracts. Describes 3 mechanisms provided by the Companies Act by which a company can sign documents. So we say a company is an artificial person. You can remember very well under characteristics of a company. We say part of the characteristics, a company is an artificial person. A company is a man-made person. A company will also have what we call a common seal, So therefore, a company, since it is an artificial person, it cannot be able to sign documents like you, a natural person, because for you, it is easy because you have your unique signature. When you want to withdraw your money from the bank, of course, basically you just need to go there, you sign, they confirm the signature is tallying or it's matching. Then of course they give you your money. But what about a company? A company cannot actually be able to sign documents, even though we are saying it is a person under the law. So how does it actually can it be able to execute its contracts or basically affirm or confirm its contracts? So for you, for the contract, you'll just be able to sign there. I've accepted the contract of employment. So they tell you sign, and you simply sign and maybe indicate the date. But for the company, it will use what we call a common seal. So they can use a common seal. So with use of a common seal, so number one, you can have use of a common seal, use of a common seal, use of a common seal. So they can be able to execute their contracts by use of a common seal. So I think a common seal, you know it. So other places they use a stamp. Instead of having a common seal, they use a stamp. But serious organizations, they use a common seal, especially maybe government entities. So just to authenticate their documents, they'll use a common seal. So this one mostly you'll see when they just press, and it will basically come as an image on the document. But for a stamp, you put ink, then you just stamp. So that use of a stamp is simply to authenticate or basically affirm the contract. Because in any case, if you go anywhere, any company will basically have to stamp its documents originating from it. So they make it become authentic that it originated from the company. So even if you are withdrawing money from the bank, they basically stamp that withdrawal slip to clearly indicate you visited the bank and actually withdraw the money. In case of any query before a court of law in future, you can easily be able to produce that particular slip, and clearly it will indicate that that particular slip originated from the bank because it has a common seal or it has a stamp. So another way how this can actually happen, so the company can actually simply just be able to appoint, or can simply be able to say, so they can be able to do what we call, they can execute through, so they can execute through an appointed or authorized person, appointed or authorized person by the company, Then number 3, they can execute through an appointed legal officer or advisor and an official person in the company, an official person in the company, like the chief executive officer, like the managing director, like the chief information officer. So they can choose such a person as a company to be authenticating or executing the contracts of the company. They can actually also be able to have like a legal officer, lawyer of the company, such that in case of any contract before it is entered into, the lawyer has to be there to confirm the contents of that particular contract. Is part of the persons who will actually be able to sign it. So they can execute through an authorized person, like a director of the company. So he's the one who has been mandated, or maybe the board of directors can choose one person to be executing the contracts of the company. So he simply signs those particular contracts on behalf of the company, So there's someone saying, I come up again on a holding company. So we say the holding company is a company, that has acquired ownership in another company. A holding company is a company that has acquired ownership in another company, and therefore it is able to control the activities of the other company, the activities or affairs of the other company. Then you've said full stop, then you just say the other company is known as a subsidiary. So I think now maybe you can look at ways through which a company can be able to issue shares. So just remember that a holding company is actually one of the classifications of companies. So they could ask how companies can be classified. So we can have a holding company, you can have a holding company and a subsidiary. We can have a foreign company. I think all those, we looked at them when we were looking at the types of companies. You can have a statutory company. We can have a chartered company. So those are the types of companies we can be able to have. If you go back to your notes, you'll be able to see them. We discussed. So we can look at methods of issue of shares. How can the company now be able to issue its shares? Methods of issue of shares. Methods of issue of shares. So we can have number one. Direct offer. Number two, we can have offer for sale. Number three, we can have what we call offer by tender. Then number four, we can have what we call placing. Then number five, the company can decide to do what we call a rights issue. So what is direct offer? So direct offer is basically where now the company publishes a prospectus by itself. So they do it directly by themselves. So they publish the prospectus, they invite the members of the public. Then after that, after the application of the shares, they give out the shares through what we call allotments. So direct offer is simply whereby the company publishes a prospectus and directly invites the members of the public to subscribe for its shares. So if they do such, we say they have done what we call a direct offer. Offer for sale, this is what actually happens. The company, instead of having to be involved in the process of preparing the prospectus and all those, they'll simply sell the shares to an issuing house. So they sell all the shares to an issuing house. The issuing house now basically is the one that will actually undertake the process of issuing the shares to the members of the public. So this is actually advantageous of the company because it saves the company on the time consumed on having to prepare the prospectus and undertake the process of issuing the shares. So what they'll do, they'll simply sell all the shares to an issuing house or a stock brokerage firm. And of course, that particular issuing house basically will sell the shares on behalf of the company. In this case, the company will save itself from maybe the time consumed in preparing the prospectus. For example, the director's time will actually be saved. So they won't actually be involved in that process. The process will actually be left to the issuing house to be involved in the whole process of giving out or issuing out the shares. If they do such, we say the company has done what we call offer for sale. Simply issuing out, basically selling out the shares, all the shares to an issuing house that basically now undertakes the process of issue of the shares. So they're involved in all the process of preparing the prospectus and now inviting people to buy the shares of the company. Offer by tender. So the company simply invites bids, and basically those who quote the expected price by the company, they're the ones who will basically be given the shares by the company or allotted the shares by the company. Placing. So what happens in this case, the company does not sell now shares like under offer for sale to an issuing house. They simply give the shares to an issuing house. And of course, now the issuing house will place the shares with, for example, key investors who are likely to buy the shares in large quantities. So in this case, the issuing house chooses specific investors in the economy who are likely to buy the shares in huge quantities. Instead of having to wait for people to subscribe for the shares, the issuing house already has those investors they know, so they can simply be able to convince them to even buy, like, let's say, for example, just for investors to buy, like, let's say, for example, all the shares of the company. So in this case, if they do such, we say they are doing what we are calling placing. So maybe they could place the shares with, for example, NSSF. So you know what NSF is actually involved in. NSF, each and every month, they basically collect amounts from Kenyan employees. So they simply save the amount for maybe retirement or maybe to be collected in the future by the employee. So that money is normally actually invested. So you can imagine the huge amount or sums of amounts they're actually able to collect in a month. So let's say, for example, if you have 4 million Kenyans who are basically contributing this particular amount, 200 shillings. So you can basically be able to calculate 200 shillings by 4 million. That's how much this particular corporate body is actually able to collect within a month. So those particular amounts, they normally invest such that in future, this particular employee can actually be able to acquire the amount with an interest. So in such a case, they could target such a corporate body that is likely to have huge amounts of money and invest in the shares, and simply convince that particular corporate body to acquire the shares in huge quantities. If they do such, we say they are doing what we are calling placing. So in this case, the company arranges with an issuing house to place the shares with key investors who are likely to buy the shares in huge blocks, Like let's say, for example, NSSF. Then you have rights issue. Under rights issue now, the company does not actually go out to the members of the public. They simply basically convince the existing shareholders of the company to acquire more shares in the company. So they issue out or they give out what we call a rights issue. Such that, for example, if you have a number of shares in the company, they give you a percentage that you can actually be able to acquire more shares in the company. Maybe in the proportion to the number of shares you have in the company, you can get more shares in the company. So in such a case, they don't go out to the members of the public. They just basically utilize the existing shareholders of the company and convince them to buy more shares of the company. So they can do what we call a rights issue. So those are the ways or methods through which a company can actually be able to issue or give out its shares, or issue or basically give out its shares. So I want us to look at maintenance of the share capital and the role in Trevor versus Whitworth. Maintenance of the share capital and the role in Trevor versus Whitworth. Maintenance of the share capital and the role in Trevor versus Whitworth. So maintenance of the share capital and the role in Trevor versus Whitworth. So what we mean by maintaining the share capital, we simply mean that the company should actually be able to ensure the share capital of the company is actually intact, such that it is not actually basically misused or not used in a proper way. Because as I clearly indicated, the share capital of the company will actually always be the fund of last resort to the creditors of the company in case the company is actually to be liquidated. So the company should devise, or there are several ways the company can actually be able to devise so that it ensures that the share capital of the company is actually maintained. So number one ways of how to ensure that the share capital of the company is actually being maintained is that the issue of shares at a discount, is generally prohibited. The issue of shares at a discount is generally prohibited. It is not actually allowed to always give out shares at a discount. Even if you give them at a discount, you must actually be able to ensure that this discount has actually been covered for. If you do that, it simply means you are not maintaining your share capital, because if you are supposed to raise a share capital by simply selling shares, let's say, for example, 1,000 shares at 10 shillings, so you're expecting an amount of 10,000, but you end up basically giving them at a discount of 2 shillings, that is 8 shillings, simply means at the end of the day, you basically raise 8,000 shillings. So you won't have actually raised the true value of the shares, the par value of the face value of the shares. If you do such, then basically you won't actually be maintaining your true share capital of the company. So that's what you are saying. For it to ensure, the company to ensure it is maintaining its share capital, one of the ways is basically to ensure that it is not giving out shares at a discount. So the issue of shares at a discount by the company is normally generally prohibited. It's not actually allowed that the company should actually always give out shares at a discount, unless they are given special reasons of how maybe they can actually be able to cover for the discount, that's when basically they can actually be allowed to give shares at a discount, to give shares at a discount. Then another way is when shares are actually issued out at a premium, these amounts should actually be maintained in what we call a share premium account. And this can actually only be applied for the specified purposes under the Companies Act. So any amounts raised out of the share premium, any amounts raised in regard to share premium must be used for specified purposes, must be used for specified purposes under the Companies Act. The Companies Act. I don't know if you can remember what we learned in the previous class. I told you that the company will maintain something known as a share premium account. So at a discount is when you are issuing them at an amount below the par value. At a premium, an amount over and above the par value. And we said these 2 shillings should actually be maintained in a share premium account, and it will be used for specific purposes. It cannot just be used, these amounts cannot just be used anyhowly. For example, I told you this particular premium can be used to basically eliminate the preliminary expenses of the company. For example, those expenses incurred by the company during the formation process, the amounts can actually be gotten from the share premium account, Then also we said, for example, if the company is redeeming preference shares at a premium, then that particular premium can be gotten or can actually be covered from the share premium account. So in case there is any share premium account that has been maintained by the company, it must be used for the specified purposes as required under the Companies Act. Not that the company goes there to draw money and actually use it for any other expenditure. It must be for those specified purposes, for those particular specified purposes. Another way the company can ensure that it is actually maintaining its share capital is to ensure that any issue of shares is for what we call money worth, So all the shares you sell, you must actually basically get money for those particular shares. So don't give out free shares. So if you give out free shares, ensure that basically you've gotten an amount to cover for the free shares. Even if you give out free shares to employees, you should actually be able to get an amount to cover for those particular free shares. Because if you give out the free shares, that particular share capital you've reported in the books of account won't actually basically be true because you didn't actually get money for it. So any issue of shares should actually be for what we call money worth. You don't give out free shares without getting any form of money. If you do such, you won't actually be maintaining the share capital of the company. So any issue of shares by the company should be for what we call money worth. It should actually be for what we call money worth. Then another way is that if the company has given out shares for any other consideration, maybe someone worked for the company, so they have decided to give him shares. So such a consideration should actually basically be covered for. So they should actually look for a way of how they can actually be able to get the amount to be able to cover for such a consideration. And of course, a clear report should actually be attached as to why that particular person is being given maybe free shares as a result of that particular consideration. Maybe someone who worked for the company, or maybe did a particular special assignment for the company, so he has been given those particular shares for that particular consideration for having worked for the company. So if there's any shares that are being given out for any other consideration, which is not actually cash, because the expected consideration that the company should actually be able to always ensure is when they give out shares, they get cash. So if there's any other consideration that they are basically using to give out the shares, maybe someone worked for the company, is not going to give out money, but it is a service he has provided for the company. Therefore, he's going to be given the shares. A clear report should actually be attached, clearly indicating what was the consideration actually given in terms of actually being able to give out the shares, and an evaluation done as to whether that service provided is worth the number of shares that have actually been given to that particular person. So if they do such, then we say the company is actually trying to maintain its share capital. The company is actually trying to maintain its share capital. Then another way is to ensure that no dividends, so you can be able to say, so that is number E, no dividends should be paid. No dividends should be paid out of capital. No dividends should be paid out of capital. So you know what dividends is. So basically dividends is normally paid out of the profits of the company. So there's no way the company will basically pay dividends out of the share capital. For example, if the company has not actually been able to make profits, it simply means that in that particular financial year, they won't pay dividends. So they cannot go to the share capital and start getting amounts from there to pay dividends to the shareholders of the company. If they do such, they will be depleting the share capital of the company. They won't actually be maintaining the share capital of the company, which is the fund of last resort to the creditors in case the company is actually liquidated. So no dividends should actually be paid out of the share capital of the company. Dividends can only be paid out of what we call distributable profits of the company. If the company has not actually been able to make profits in a financial year, it simply means that the company won't pay dividends to the shareholders. If the company has made a loss, they won't pay dividends to the shareholders. You as shareholders, you'll come out empty-handed in that particular financial year. There is no way the company will go to the share capital and get amounts from there to be able to pay dividends. If the company has declared a loss in a year, they won't pay dividends. So no dividends should actually be paid out of capital. If they do such, the company won't be maintaining the share capital of the company, the share capital of the company, the share capital of the company. So just attached to the maintenance of the share capital, there's a rule which is actually also basically enabling the company to also be able to maintain its share capital. There is this particular rule that is known as the rule in Trevor versus Whitworth. So this particular rule simply states that a company cannot purchase or finance the purchase of its own shares. So part of the ways of maintaining the share capital is to observe this particular rule, whereby it simply states, so apart from these reasons we've given or ways we've given or how the company can maintain its share capital, also these particular rules give guidelines of how the company can be able to maintain its share capital, because this particular rule states that a company cannot purchase or finance the purchase of its own shares. Kampuni iwezi nunua shares zake ama ipatie mtu pesa anunue shares zake. If they do such, also they won't be maintaining the share capital of the company. Therefore, the company must always observe this particular rule. So whereby it simply states the company cannot purchase or finance the purchase of its own shares. So this rule talks about particular investors or particular minority investors who had actually basically acquired shares in the company. So at a particular point, they sold back the shares to the company, but the shares were not actually paid in full. The company paid for part of the shares. So of course, the company was liquidated. And of course, on liquidation, we are saying that creditors have to be paid. So it simply means these guys who had actually basically sold back their shares to the company and they were not fully paid were creditors to the company. So since in this case, they were supposed to be listed on liquidation. So this case went to the court, and of course, basically what was actually ruled that amount that was due to these particular investors in terms of the shares being bought back by the company and were not fully paid, the remaining amount was not supposed to be paid, because a company generally cannot actually basically be able to purchase or finance the purchase of its own shares. If they do such, they won't actually be maintaining the share capital of the company. So maybe you can just be able to look at this particular rule. You get the facts of what the teacher is saying. You get the facts of what the teacher is saying, or what the teacher is saying. What is the teacher saying? What is the teacher saying? So it is here, the rule in Trevor versus Whitworth. This one is actually very famous. It is a rule you cannot afford to forget. Most probably, it will be tested. So you must actually be very keen. The rule states like this: the rule restricting a company from buying its own shares or financing the acquisition of its own shares was laid down in Trevor versus Whitworth. In this case, just listen very carefully. In this case, a shareholder sold back his shares to the company, upon which he was paid part of the price. Before being paid the balance, the company went into liquidation. He claimed from the liquidator the balance of his money on the shares he sold back to the company. You can see what actually happened, that this particular shareholder sold back the shares to the company and they were partly paid. So kuna deni alikuwa bado anadai hiyo kampuni. So on liquidation, the liquidator, so this guy who normally actually lists down all the creditors on liquidation is known as a liquidator. So he basically was supposed to pay this particular balance. So this particular shareholder was claiming for the balance on his shares that he had sold back to the company. So the claim, this went to the courts, and this is actually what actually happened. The claim was dismissed, and the court observed that a registered company had no power to purchase its own shares, and that the claim was ultra vires. It was further held that the object of the company legislation was to prevent this in order to preserve capital intact. This being virtually the only fund on which a limited company creditors could rely, since they cannot proceed against the private estates of the members. So you can see in this case, this is basically the way in which a company can be able to maintain its share capital intact. Because if the share capital of the company is not intact, you cannot go ahead asking the shareholder of the company to bring in their private assets. That's what they are saying there. You cannot go for the private estates of the members. You as a shareholder, let's say for example, Tuskys. If Tuskys is a limited company, there's no way creditors of that particular company can come for your private property and ask you to basically pay for the liabilities of Tuskys. The extent they can only be able to go to is only the share capital of Tuskys. And since if it has been maintained intact, that's basically where they'll get the money to pay the creditors of the company. So therefore, if the company is basically buying back its shares, it simply means that it is not actually maintaining its share capital, is not actually maintaining its share capital. So therefore, one of the ways, apart from the ones we've just listed as to how the company can be able to maintain its share capital, is to observe this rule, or simply to avoid the purchase or financing the purchase of its own shares. So there are two things the teacher has said. The teacher has said purchasing or financing the purchase. Purchasing or financing the purchase. What is to finance? Finance is to give another person money, then he buys the shares of the company. What is purchasing? Purchasing, you directly purchase. Financing is to give another person the money, then he buys the shares of the company. So you can see there are two things that are coming out here. So they are basically prohibiting directly purchasing or giving another person the money, then he comes to buy the shares of the company. So what you need to be able to know, this rule, as other major rules you come across in company law up to this particular point, it has exceptions. It does not prevail always. Under certain special circumstances, the company can buy its own shares. Under certain circumstances, a company can finance another person to buy the shares of the company. So it has exceptions. Just like other major rules we come across in company law, the rule in Trevor versus Whitworth, it has exceptions. So what are the exceptions? The exceptions are categorized into two, under directly purchasing and also under directly financing. So you can look at the exceptions. So you can just go through the exceptions just down there. So the following exceptions exist under the rule of Trevor versus Whitworth. When they talk about exceptions, they mean sasa under these particular circumstances, kampuni sasa inaweza hata nunua shares zake. So that rule does not actually prevail under those circumstances. Or it can alternatively give another person money, then he goes and actually basically buys the shares of the company indirectly. So they have been categorized into two. They have been categorized into two. So where the company directly purchases or finances the purchase, like those first ones, these ones, is where the company is financing another person, exceptions where it can finance. And then these ones is where the company can directly purchase. So under the first one, you can see what they are saying, where the company provides financial assistance for the purchase of its own shares, where lending of money is part of the ordinary business of the company, and the money is lent in these circumstances, e.g. a bank. So you know the ordinary business of a bank is normally to give out loans. So a bank like Kenya Commercial Bank, they give out a loan to someone today. The next day, the person goes on the stock exchange or basically buys the shares of the company. So since it is the ordinary business of the bank to give out loans, so it is not prohibited. In such a case, it can actually be allowed to finance because it is the ordinary business of the bank. That is their major business activity. They give out loans to make profits in terms of interest. So they can give out a loan today and someone tomorrow basically comes back to buy the shares of the company using the same loan. Then number two, where a company provides money under any employee share scheme for the purchase of fully paid shares to be allotted to deserving employees. So maybe the company has some of the packages they have given in terms of its employees. If you maybe perform so well, they can give you some amount of money, you buy the shares of the company. So it's like a compensation scheme they have in the company. So like a package, part of the allowances they have in the company. Apart from housing allowance, they have another scheme, another employee scheme, whereby, for example, if you have performed so well, they can give you money, then you buy the shares of the company. You can see they are financing you. So they give you the money, then you end up coming to buy the shares of the company. So under that particular exception, the company can finance. Then number three, where a company makes a loan to an employee or gives out a loan to an employee, and of course the employee uses the loan to acquire the shares of the company. Remember, under number two, you are saying it is a scheme. They have that scheme in that company. If you go to that company, if you are employed there, they have a scheme whereby they normally give money to their employees, then they buy the shares of the company. Then under this one now, they give you a loan, so you can apply for a loan in the company. They don't know what you are going to use for the loan to do, but eventually you use the loan to buy the shares of the company. And then the last one, where a shareholder receives cash dividends, and instead of basically having to take the dividends, he utilizes the dividends to buy the shares of the company. So you as a shareholder of the company, you are given dividends, let's say, for example, 100,000, worth 100,000. Instead of taking that particular cash dividends, you simply ask the company to give you extra shares, or you acquire extra shares in terms of that amount you've been given as dividends. So you can see in those instances, the company is actually able to finance. So it is actually financing other parties to buy the shares of the company. So under those exceptions, the company is actually able to finance, to finance the purchase of its own shares. Then under what exceptional circumstances can the company now directly purchase? So number one, in case of a valid reduction of capital sanctioned by the court. So this one I'm going to explain just after this. Then in case of redemption of preference shares. So you can remember what we learned about redeemable preference shares. I told you these are the shares the company can be able to redeem. What is redeeming? Buying back of preference shares. So if the company has redeemable preference shares, it can actually be allowed to purchase back those particular redeemable preference shares, because basically that's what normally happens in case of redeemable preference shares. You as a shareholder, you hold the shares for a number of years. Then once that particular term actually expires, the company buys back the shares. So where the company is ordered by the courts to buy the shares of an oppressed minority shareholder. Maybe you are not satisfied as being a shareholder in that particular company. So you go to the courts and basically bring your complaint as to why you want to exit as a shareholder. So the court simply compels the company to buy your shares. They give you back your money and you lose the shares of the company. So in such a case, if the court gives out an order that the company purchases the shares of an oppressed minority shareholder, in such a case, the company can now directly purchase the shares. Then number four, in case of a valid forfeiture of shares. You can remember what we learned about forfeiture of shares. So simply cancellation of your shares in case you're not actually able to pay any outstanding amount on your calls. So the company can forfeit the shares. So they can simply cancel out your shares and simply give you back the amount of money. So depending on the agreement. In case of a valid surrender of shares by a member, so you can validly surrender your shares as a member. You no longer want to be a shareholder in the company. So if you give valid reasons, then of course the company can give you back your money, and of course you lose the shares of the company. So those are basically ways through which the company is actually allowed, or we can simply be able to say they are the exceptions under the rule in Trevor versus Whitworth. So those are the exceptions under the rule in Trevor versus Whitworth. It is a very common area in the exam. You can't afford to walk in an exam room and you are blank with regards to this particular rule. You can't afford to walk into an exam room and you are blank. What is the rule in Trevor versus Whitworth? It is very common in the exam. It is very common in the exam. And of course, the trick is they'll trick you with purchasing and financing. So they'll simply ask you, state the exceptions under which the company can finance the purchase of its own shares. Since you've not gotten the term financing, you'll end up basically stating the ones under purchasing. So that will be the trick, because maybe they'll know the student is actually very clever. He'll easily tell those exceptions. So they'll simply trick you by simply asking you to maybe state those ones, only those ones under financing. So if they don't clearly state which ones you're supposed to state, you can just mix them without even having any concern as to whether they are under financing or maybe they're under purchasing. They're under purchasing. So it's an area when you are going through the notes or when you are privately revising to be popping your eyes there, just be checking to remind yourself. But of course, we'll redo it again in blocks. So, but it's a very common area in the exam. So you can look at share capital reduction. So I want us to look at share capital reduction, share capital reduction. Share capital reduction, share capital reduction. So just from the word reduction, so the company can decide to reduce its share capital. The company can decide to reduce its share capital. For example, if they have, let's say, for example, 10 million, they decide we want to reduce it maybe up to 8 million or maybe up to 6 million. That is what we mean by share capital reduction. Several reasons could actually basically lead to the company deciding to reduce its share capital. For example, if number one, so it's part of the reasons, if the share capital, if there are no assets, you can simply be able to say if there are no assets. So reasons for reduction, if there are no assets, to represent the share capital. If there are no assets to represent the share capital, so if the share capital is in excess, if the share capital is in excess of the needs of the company, to extinguish or cancel any outstanding or unpaid amounts on the shares, unpaid amounts on the shares. For example, they gave out the shares, but some people have not actually been able to pay up for that particular capital. So they simply just cancel it out or reduce it. So they had basically registered a share capital of 10 million, expecting people will buy the whole of it. But only after the subscription, maybe like 8 million has been realized. So they have been trying to realize the 2 million, so they are not actually able. So they simply just reduce up to that particular 8 million they have been able to raise. And then if the share capital is in excess of the needs of the company, so they have 10 million, just 4 million is just idling. So they don't need it, so they can reduce it. They can reduce it. And of course, the method of reduction, they'll simply decide upon themselves whether they'll do a buyback of the shares. They can decide how they are going to do the share capital reduction. Then if there are no assets represent the share capital, so sometimes they can be able to decide to reduce the share capital. So to be able to explain this particular first point, so here, you of course know, so you have the non-current assets. Then you have the current assets. This is something you know. This is the balance sheets. This is the balance sheet. This is not new to you. So you have equity and liabilities. So we have equity or here. So share capital will be part of the equity. Share capital will be part of the equity. Then we'll have here non-current liabilities. Then we'll have the current liabilities. So this other side, so this is the balance sheet. So this side basically balances with the other side. So this share capital is normally represented by assets this other side. It is represented by assets this other side because when you raise share capital, you simply invest in assets. For example, you'll buy machineries. You'll put some of the amount in the bank accounts. You'll buy buildings. So when you do the double entries, for example, let's say the company raised cash worth this, so the amount is maintained in the cash account. It will be moved from the cash account to acquire machineries. So you can see basically this share capital you've raised here, it does not just idle in the company as cash, it is simply put in assets. So for example, they buy machinery to manufacture the products of the company. So that is basically money that was raised through sale of shares. So the company didn't have machinery. So they had to raise the share capital for people to bring in money. Once the money came in as share capital, it is now being represented by those machineries, which are basically manufacturing products in the company as part of the non-current assets. But basically what you have to realize, this machinery basically sometimes they depreciate, they lose value. So it simply means that, for example, if you raised 10 million and you fully put it in machinery of 10 million, so you raise 10 million as share capital by sale of shares, you fully put the whole amount in machinery as 10 million, most probably after 2 years or maybe 5 years. So this machinery is probably at 8 million after depreciation. So it simply means that the valuation of the shares of the company has to be redone. So it will basically reduce the share capital of the company because there are no assets that had been acquired to represent this particular value of share capital in the company. So if there are no assets represent the share capital, the company can decide also to do a share capital reduction, So those are part of the reasons as to why the company will decide to do a share capital reduction. So there is normally a procedure that is normally followed when the company is to do a share capital reduction. So they don't just wake up and just say we are going to do a share capital reduction, because as I've told you, the company should actually always maintain its share capital. So once they are reducing, they are not maintaining. So of course, the court has to be involved before the company can do a share capital reduction, because if they just reduce the share capital reduction without following the proper procedure, it simply means that they are basically depleting the share capital of the company, which is the fund of last resort to the creditors of the company in case of liquidation. So once they are doing it, they are not maintaining it. So they have to do it by following the right procedures. So what is the procedure? The procedure is actually very important for you to be able to understand. The procedure is actually very important for you to be able to understand. So what will happen in the company? Number one, what will happen is the company will convene a general meeting, the company. So this is the procedure of share capital reduction. Procedure of share capital reduction. Procedure of share capital reduction. So the company will convene a general meeting, and pass a special resolution, for share capital reduction, So they'll convene a general meeting in the company and pass a special resolution for share capital reduction. What is a special resolution? So I think this one I've explained previously, but I know most of you have forgotten. A special resolution is basically a resolution or a decision in the company that must be approved by what we call supermajority. Supermajority simply means that at least 3/4 of the members of the company with voting rights of at least 3/4 of the shareholding of the company should actually be able to approve it. It simply means that it must actually be approved by 75% of the voting rights of the company. That is what we mean by a special resolution. So share capital reduction in the company, what we mean, it must actually be approved by at least 3/4 of the members of the company who are supposed to attend and actually vote at such kind of a meeting. So it must actually be approved by super majority. If it is just 50%, we call it ordinary resolution. Ordinary resolution. So ordinary resolution is simply a resolution that just requires a simple majority. Simple majority, like for example, appointment of directors, like for example, appointment of auditors. You don't need a super majority to approve. So long as 50% have agreed that this will be the auditor of the company, then that is okay. But for things like share capital reduction, since they're actually very crucial, they must be approved by a super majority or a special resolution. So other things like, let's say, for example, change of articles, they require a special resolution. Other things like, let's say, for example, change of name of the company, they require a special resolution. Other things like, let's say, for example, mergers and acquisitions. For example, if NIC Bank is to merge with Commercial Bank of Africa, then of course it must actually be approved by super majority of members of these particular two companies. If Quickmart is to acquire another supermarket known as Tumaini, then of course majority of the members at Quickmart should actually be able to approve that particular acquisition. So it requires a special resolution. So certain resolution or decisions in the company will require these ones to approve. Others just require an ordinary resolution. So, but this one basically you'll learn more about it when we're looking at the topic of company meetings. But it is important you understand it at this particular point. So what the company has passed this particular special resolution, so they'll basically petition the courts. They'll petition or basically present to the courts, petition the courts for a share capital, petition the court for a share capital reduction. What we mean by this, they'll simply get that resolution that they have approved and present to the court. Of course, that resolution will basically contain reasons as to why they want the share capital reduction to be done. So they'll simply present to the court, a court of law, so that it can be able to approve it or sanction it. So once they are presented it, there are several things that will actually happen during that process in the court. Number one, what the court will do, the court will list all the creditors of the company, list all the creditors of the company. The court will list will prepare a list of all the creditors of the company. The court will list all the creditors of the company. Will list all the creditors of the company. And if there is any creditor who has not been included in the list, he will be called upon to basically present himself to the court so that he can actually also be listed. So they'll prepare that list. If there's any creditor who thinks that his name is not actually included, he'll likely also be asked to come forward and basically present evidence as to why he's one of the creditors of the company. Then what will happen? If there is any creditor objecting to the share capital reduction, if there is any creditor, objecting to the share capital reduction, the company will be asked to dispense of the creditor, with the creditor. So if they have listed the creditors, and now out of the creditors, they have realized there's a creditor who is actually objecting. He doesn't want the share capital reduction to be done. What they'll do as the court, they'll simply ask the company, what you do, pay this creditor because he's the one who is objecting. Now the question should actually come to your mind. Why is it that the creditor is objecting? The question should come to your mind when the teacher says that they list the creditors. Why are they listing the creditors? That is what you should be asking yourself. Because we've said share capital is the fund of last resort to the creditors of the company in case of liquidation. So therefore, they are key stakeholders. So the court has to involve them. Because if they are not actually involved and the share capital reduction is done, then at the end of the day, the company is liquidated and there is no money to pay them. They'll simply basically blame the court. So that's why the court is normally involved. They list all the creditors, and in case they list all the creditors, and in case these particular creditors are actually objecting, they can ask the company to dispense of or pay off the creditors before they can actually be able to do the share capital reduction. Then after that has actually happened, that they have actually been able to ask the company to dispense of with the creditors, and the company has done so, the court will give out an order. The court will give out an order for share capital reduction. So that order by the court will be given out after having dispensed off with the creditors of the company. So the court will give out an order for share capital reduction, So this court order will be filed. So number 6, the court order will be filed with the registrar of companies, So they'll give a copy or file it with the registrar of companies. Then the last thing that will actually happen, the company will proceed with the share capital reduction. And the method of basically share capital reduction will be upon the company to be able to decide whether they'll buy back the shares or what will they be able to do, or how will they go about the share capital reduction. So that is basically the procedure of share capital reduction. So we've said convene a general meeting, pass a special resolution. This one is basically used to petition the court or ask the court for an order of share capital reduction. Once the court gets the petitions, they list all the creditors and ask any creditor who is actually basically not listed to basically present himself. And if there is any creditor who is objecting, doesn't want the share capital reduction to happen, they'll ask the company to dispense of or pay off the creditor. Then the court will give out an order of share capital reduction. Once the company has been able to dispense with any creditor who is actually objecting to the share capital reduction, then of course the court, the company will file that particular court order with the register of companies as evidence that they have actually been allowed to do a share capital reduction. Then of course, after that, the company will commence with the share capital reduction, and the methods of share capital reduction will be upon the company to be able to decide as to how they'll proceed with the share capital reduction, as to how they will proceed with the share capital reduction. They'll proceed with the share capital reduction. So that is the procedure of share capital reduction. So I think you've actually been able to understand. So I think we'll end there the class. So next time we'll start the topic of debt capital, but I will look briefly at dividends, just a small bit about dividends. Then we'll be able to start the next topic of debt capital, the next topic of debt capital, the next topic of debt capital. So I think we can end there. So I think we'll meet next time. So unless you have a question, maybe you can post on the group. You can post on the group. You can post on the group, or you can. Is there anyone with a question really? So I think we can end there. We can end there. We'll meet next time. We'll meet next time.